On the final trading days of 2025, something extraordinary and largely unnoticed took shape beneath the surface of the global financial system. 7 companies, household names known across every continent, quietly came to represent nearly 1/3 of the entire value of America's most important stock index: Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla. Together, these 7 firms reached a combined market value exceeding $14 trillion, more than the total stock markets of Japan, Germany, and the United Kingdom combined. At first glance, this seemed like a triumph of innovation, a validation of technology's dominance, proof that the digital economy had reshaped the modern world. But history teaches us a different lesson. When wealth concentrates this tightly, when valuation detaches from growth, and when belief replaces mathematics, the system becomes fragile, not strong. This is not a story about bad companies. These are some of the most profitable, influential corporations ever created. Their products define daily life. Their technologies shape geopolitics. Their balance sheets are envied worldwide. The risk does not come from weakness. The risk comes from scale. Never before, not in 1929, not in the 1970s, not during the dot-com era, has so much market value rested on so few stocks at such elevated prices. By the end of 2025, these 7 companies alone accounted for more market capitalization than the bottom half of the S&P 500 combined. 250 companies together were worth less than 7. That is not diversification. That is dependency. And dependency creates consequences. For most investors, this concentration is invisible. Retirement accounts appear diversified. Index funds promise exposure to hundreds of companies. Target date funds suggest safety through automation. Yet beneath the surface, a silent transformation has taken place. The modern investor no longer owns the market. They own the same 7 companies, over and over again, through every passive vehicle they hold. This shift did not happen because analysts concluded these businesses were worth any price. It happened because the structure of modern investing rewards size, not value. As money flows into index funds, it is allocated mechanically. The largest stocks receive the most capital. Rising prices increase their weight. Higher weight attracts more money. More money pushes prices higher. It is a feedback loop, elegant on the way up, merciless on the way down. This is how concentration accelerates without intent. No conspiracy is required. No single decision maker controls it. The system does it automatically. Over the past decade, passive investing grew from a niche strategy into the dominant force in global markets. Trillions of dollars moved from active judgment into algorithmic allocation. Price discovery weakened. Valuation discipline eroded. Popularity replaced analysis. And gradually, year by year, the same companies absorbed more capital, regardless of fundamentals. By late 2025, the process reached an extreme. These 7 firms were trading at valuation levels historically reserved for young, fast-growing disruptors, despite having matured into global incumbents. To justify their prices, earnings would need to grow at rates rarely sustained beyond short bursts. But growth was no longer accelerating. It was slowing. Apple's core product, the iPhone, had reached saturation. Global smartphone demand plateaued. Replacement cycles lengthened. Incremental upgrades failed to drive volume. Microsoft's cloud growth, once explosive, began to decelerate as enterprise adoption matured. Nvidia's extraordinary rise was tied to an infrastructure build-out that, by definition, could not expand forever. Amazon's cloud division slowed, while its retail margins remained structurally thin. Alphabet faced the first credible disruption to search in its history. Meta's engagement shifted toward lower monetization formats. Tesla's vehicle growth fell into single digits as competition intensified. None of this meant collapse, but it meant something far more dangerous. The story no longer matched the price. Markets can tolerate slow growth. They cannot tolerate unrealistic expectations. Valuation is not an opinion. It is a mathematical relationship between price, earnings, and future assumptions. When expectations overshoot reality, the adjustment is inevitable. And when adjustment begins in the largest stocks, the same stocks held by every pension fund, every index fund, every retirement plan, the consequences do not stay contained. This is where history becomes relevant. In every major market cycle, periods of extreme concentration precede instability. The names change. The narratives evolve. The technologies differ, but the structure repeats. In the early 1970s, institutional investors crowded into a small group of dominant corporations believed to be untouchable. They were known as one-decision stocks. You bought them and never sold them. They were the best companies, the safest bets, the future of American capitalism. Their valuations rose far beyond historical norms. When growth slowed and economic conditions shifted, those same stocks fell harder than the broader market, despite remaining profitable businesses. The lesson was brutal but clear. Great companies do not guarantee great investments when bought at extreme prices. By 2025, that lesson had been forgotten. The modern equivalent of the one-decision trade was passive ownership of the largest technology stocks. No judgment required, no valuation limits applied, just automatic accumulation. And as long as prices rose, the strategy appeared flawless. But systems built on momentum are vulnerable to reversal. When earnings growth disappoints, when narratives weaken, when capital flows change direction, the same mechanism that inflated prices begins to unwind them. Selling begets selling. And because of concentration, the impact multiplies. This is not a prediction driven by emotion. It is a structural reality driven by arithmetic. When a third of market value depends on a handful of stocks sustaining extraordinary growth indefinitely, the margin for error disappears. As 2026 approached, that margin was gone. What comes next is not triggered by panic, it is triggered by normalization. And normalization, in a system this concentrated, carries consequences far larger than most investors are prepared for. In the next part, we examine how valuation compression begins quietly, mechanically, and why the first phase of decline rarely feels like a crisis at all. It feels like reassurance. Until it doesn't. The first phase of a systemic unwind never announces itself as a crisis. It begins quietly, almost politely, disguised as normal market behavior. Prices drift lower. Analysts call it a pause. Commentators describe it as healthy consolidation. Long-term investors are encouraged to remain calm. And for a while, that advice appears correct. In early 2026, the initial declines in the largest technology companies do not feel dramatic. Single-digit drops are absorbed easily by portfolios that have enjoyed years of gains. Volatility rises, but only modestly. The narrative remains intact. Yet beneath the surface, something far more important is happening. Expectations are changing. Not collapsing, adjusting. And in markets dominated by valuation, adjustment alone is enough to trigger powerful forces. When earnings reports arrive, the numbers still look strong in absolute terms. Profits are high. Cash flows are healthy. Balance sheets remain robust. But growth is no longer accelerating. For companies priced as if acceleration will continue indefinitely, deceleration matters more than decline. This is the moment when valuation compression begins. It does not require a recession. It does not require a financial shock. It does not require geopolitical conflict. It only requires reality to fall short of belief. When a stock trades at 40, 50, or 70 times earnings, investors are not buying today's profits. They are buying a future that assumes rapid expansion, sustained dominance, and minimal disruption. If that future becomes less certain, the price must adjust, even if the company remains profitable. This adjustment rarely happens all at once. It happens quarter by quarter. Guidance softens. Analysts trim estimates. Price targets inch lower. Multiples quietly contract. At first, investors interpret this as opportunity. They have been conditioned to believe that declines in large technology stocks are temporary. For more than a decade, buying the dip has been rewarded. That conditioning matters, because it delays recognition. As prices fall modestly, capital does not immediately flee. In fact, many investors add exposure, convinced that weakness is temporary. This delays the correction, and makes it worse. Meanwhile, the mechanics of the modern market begin to shift. Passive funds do not think. They do not analyze. They do not anticipate. They respond. As long as money flows into index funds, the largest stocks continue receiving the largest allocations. But when flows slow, or reverse, the same rule applies in the opposite direction. Redemptions require selling, and selling is proportional to weight. Because these 7 companies dominate the index, they dominate the selling. This is not a judgment call. It is a risk. When investors withdraw capital from index products, the funds must liquidate positions across the portfolio. A third of every dollar redeemed comes from the same 7 stocks. As prices fall, market capitalizations shrink. As market caps shrink, index weights decline, but not fast enough to prevent further selling. The system lags, and during that lag, pressure builds. At the same time, volatility begins to rise. Volatility is not just a psychological phenomenon. It is an input variable in automated strategies that control trillions of dollars. Risk-managed portfolios, volatility targeting funds, and risk parity strategies are designed to reduce equity exposure when volatility increases. They do this automatically. They do not ask why volatility is rising. They only respond to the signal. As markets become more unstable, these funds begin to sell equities, not selectively, but broadly. The selling pushes prices lower, which increases volatility further, which triggers additional selling. This feedback loop is mechanical. Overlay this with the options market. Over the preceding years, investors generated income by selling call options on large technology stocks, betting that prices would remain stable or rise gradually. Market makers who facilitate these trades hedge their exposure dynamically. When prices fall, hedging requires selling the underlying shares. As declines accelerate, this hedging becomes more aggressive. Another source of selling enters the system again, without reference to fundamentals. Then momentum strategies begin to reverse. For years, these stocks were leaders. They attracted capital precisely because they were rising. Momentum strategies amplified their ascent. But momentum cuts both ways. When technical levels break, when trends reverse, these same strategies exit positions often rapidly. They do not wait for valuation to stabilize. They exit when the signal changes. By this stage, the market no longer responds to earnings. It responds to flows. This is the critical transition point. Markets move from valuation-driven behavior to liquidity-driven behavior. And liquidity-driven markets can move far faster than fundamentals justify. As prices fall, confidence erodes. Not because investors believe the companies are failing, but because they realize that ownership is crowded. When too many portfolios rely on the same assets for stability, stability disappears. This is when correlation rises. Assets that were previously uncorrelated begin to move together. Defensive positioning fails. Diversification within the same asset class stops working. The belief that owning hundreds of stocks ensures safety is revealed as illusion, because ownership is concentrated in the same few names. At this stage, media narratives change. The language becomes cautious, then concerned, then urgent. Terms like rotation give way to repricing. Optimism turns into uncertainty. Institutional investors begin reducing exposure, not because they want to, but because they must. Risk committees intervene. Exposure limits are hit. Drawdown thresholds trigger action. The selling becomes self-sustaining. And still, this is not panic. Not yet. The most dangerous phase is the one that feels controlled, because it convinces participants they have time. But time is exactly what disappears once confidence breaks. In the final stage of the unwind, the question shifts from, is this a correction, to where does it stop? That question has no immediate answer. Because in a system driven by concentration and leverage, prices do not stop falling when value appears. They stop falling when forced selling ends. And forced selling only ends when those who cannot sell anymore are exhausted. In the next part, we examine how this process completes, how history repeats not through identical events, but through identical structures, and why the aftermath reshapes markets for years, not months. Every market cycle ends the same way. Not with a single event, but with exhaustion. By the time the final phase of a downturn arrives, the debate is no longer about valuation, growth, or narratives. Those questions belong to the early stages. What remains is liquidity. Who must sell? Who can wait? And who still has capital when prices stop falling? As the concentrated decline in the largest technology companies accelerates, something subtle but important happens across the broader market. The illusion of safety breaks. For years, investors believed that scale itself provided protection. That the largest companies, with the strongest balance sheets and the deepest moats, were immune to serious drawdowns. History disagrees. Scale magnifies impact. When the largest companies fall, they do not fall alone. They pull entire portfolios, benchmarks, and institutions with them. By mid-cycle, selling is no longer driven by fear. It is driven by necessity. Margin requirements rise as volatility increases. Leveraged investors are forced to reduce positions. Funds that promise stability discover that stability requires liquidity, and liquidity requires selling. This is the moment when rational behavior becomes irrelevant. Strong hands and weak hands are treated the same by the market. Price declines trigger more selling. Selling creates lower prices. Lower prices trigger still more selling. This is not panic. It is mechanics. The final leg down often arrives without a dramatic headline. There is no single announcement that marks the bottom. No universally recognized signal. Instead, the market simply stops responding to bad news. Earnings disappointments no longer shock. Economic warnings no longer accelerate declines. The selling pressure fades, not because optimism returns, but because those who needed to sell have already done so. At that point, valuations begin to matter again. But the market that emerges is not the market that existed before. Concentration unwinds. Leadership changes. The companies that once dominated every index no longer command the same share of capital, not because they disappeared, but because their prices reset. This has happened before. In the aftermath of past concentration cycles, the strongest companies survived, but investors who paid extreme prices waited years to recover. Time did not heal the wound quickly. It diluted it. And this is the part most investors misunderstand. Surviving companies do not guarantee surviving portfolios. A stock can remain profitable, innovative, and influential, and still deliver a decade of poor returns if purchased at an excessive valuation. This is how wealth transfers occur. Not from the collapse of businesses, but from the repricing of expectations. Those who entered late, who assumed safety in size, who relied on passive exposure during a period of extreme concentration, they absorbed the loss. Those who retained liquidity, who diversified beyond a single asset class, who recognized that price matters even for great companies, they gain optionality. Optionality is power during market resets. Cash is not an investment when markets rise. It is an advantage when markets fall. In the years following major concentration unwinds, markets behave differently. Returns become uneven. Volatility remains elevated. Leadership rotates away from the former giants. New narratives emerge. Some sectors recover quickly, others stagnate. The index eventually rises again, but it does so on a different foundation. This is why recovery does not feel like victory. It feels like rebuilding. The most important change, however, is psychological. Belief in permanence fades. The idea that any group of companies deserves unlimited valuation is replaced by skepticism. Risk is reintroduced into decision-making. This is healthy. Markets cannot function indefinitely on faith. They require discipline, and discipline returns only after excess is removed. For long-term investors, this period is not the end of opportunity. It is the beginning of selectivity. The mistake is not owning large companies. The mistake is believing size eliminates risk. Concentration amplifies it. As the system rebalances, the question every participant faces is not whether markets will recover. They always do. The question is who will still be positioned to benefit when they do. Because the greatest losses are not suffered by those who endure volatility. They are suffered by those who mistake structure for safety. What unfolds next is not a collapse of capitalism, nor the failure of innovation. It is a recalibration, a return to gravity. And gravity, in markets as in nature, cannot be suspended forever. Understanding that reality does not require prediction. It requires perspective. This is not financial advice. It is an examination of how concentration, valuation, and structure interact over time, and why periods of extreme imbalance always resolve the same way. Quietly at first, then all at once.